the other part of this, we want to have fun with it. And since I know this group, we should be able to have some fun. So Rick from MINDBODY, Lopo from Wahanda, Annbeth from Exhale, Josh from Booker, and Sammer, who you heard earlier, from Zeel. So I just thought I'd let them start out with sharing their name, a bit about their company, and some money that they've raised from what sources. And all of them get to participate with that question. We'll start out, we'll leave the last one for Sammer because he's always got a little bit of color going here. So Rick will give you a breather for just a little bit because you got in here real quick. So we'll start with Lopo.
Okay. Hi, everybody. I'm Lopo, and I'm the co-founder of Wahanda. And Wahanda is the largest marketplace website in Europe for booking hair and beauty services. We're in 10 countries in Western Europe. And I guess in terms of fundraising, we've raised in our history now just shy of $140 million. All
right, very good.
Not all at once.
What? Okay, Josh?
Sir, Josh McCarter with Booker. We're a business management and marketing solution that's targeted at service-based businesses. We started out actually as a division or a product within Spafinder, and then spun that out to really go after a larger market opportunity for a variety of service-based businesses. We did that in 2011. Since then, we've raised about $80 million. We just did a round of financing earlier this year. And right now, we have about 10,000 locations that we're supporting, a lot of hospitality clients, but also a lot of small and medium businesses, mostly in North America. We do operate in 70 countries, and that's kind of a quick thumbnail.
So Annbeth was a little bit concerned because she wasn't...
I don't belong here.
That's what she thinks, but actually she does. We love having her here because she has raised capital. She's got a very successful company, and I use her facility many times each week because Exhale's in the building that I live in. So Annbeth.
Thank you. So I'm Annbeth, and I'm the CEO and founder of Exhale. And Exhale is a well-being lifestyle brand and business, and it's one of the first, if not the first, concepts that really broke away from the traditional spa and gym orientation to create a new paradigm in the space that integrates boutique fitness class programs with spa and healing, and everything that we do is mind, body, and transformational, and that's all under one roof. And so since inception, Exhale has grown from, my vapor and vision and passion and crazy thinking and a, business model and 4-year projections to 30 boutique locations as of the end of this year in 11 markets with about a dozen proprietary boutique fitness programs and spa and healing programs and 2,000 associates. And we're sort of at a point now where the brand is now sitting perched really in the sweet spot of a very attractive high-growth sector, which is the boutique fitness sector. And so it's a really exciting time for Exhale. And we raised money. We got funded from private equity, which is a really unusual route for an organic growth business model such as Exhale to take, but I was impatient and I was very bullish and I wanted to be first and I wanted to move fast, so
right, very
that's
good.
the story.
Thank you. Okay, well, Rick, how about you? You've got had a lot of success in raising capital over the years. And tell us a little bit about your company.
Sure, MINDBODY is really two things. It's a comprehensive business management solution called a SaaS software, web-based and mobile-based. We just crossed 50,000 businesses in 134 countries and territories running on our system. They employ about 300,000 practitioners, teachers, trainers, therapists, stylists, estheticians, serving about 26 million consumers. And we're also, and our original goal from the garage was to become a transaction-enabled marketplace, that we could be a platform by which more people could be connected to these wellness practitioners. And so we're thrilled today to have achieved that. It only took 15 years to get to this stage. Did you have a follow-on? One of our clients, by the way, is Annbeth, Exhale Spa, running on our system.
She got MINDBODY everywhere in her place. In her philosophy and in her software, huh?
Yeah.
Okay, Sammer.
Sure. So I'm Sammer, Zeel. We refer to ourselves as Massage on Demand. Press a button, get a massage in as little as an hour. And we're in 6 major metro markets in the United States. I think it works out to like 14 different cities, my PR team tells me. And you heard, hopefully, most of the talk yesterday about what we do and what we're trying to achieve with spas as well. In terms of money, even though Annbeth won't tell us how much money she's raised, I'm sure that I've raised the least amount in this group, because I think, Rick, didn't you raise $100 million in the IPO? 80? Something like that. That was public. So we've raised about $7 million, primarily from VCs like Lightbank, which is the VC arm of the Groupon founders, and Slow Ventures, which is a VC fund started by some early Facebook guys with significant money from Mark Zuckerberg, and then some other VCs like that, including Partech Ventures, which is a $700 million fund out of Paris. So, quick thumbnail.
So I think one of the things that becomes interesting is you start to get and start to look for investment, and you have to go reflect on your company a little bit and think about how what your business model is. And so before we kind of get into some of the things that investors look for, I think it'd be kind of fun to hear how maybe there's been some morph in these businesses as they went along and started talking to investors and how they've had to change their business models. And so Lopo, why don't you give us a little idea of what you've been through?
How much time do I have?
Well, no, you can be fine. I've had a great time watching Lopo in this. I sat back and watched him years ago when he came into the marketplace, and he kept putting twists on it and twists on it and twists on it, and all of a sudden, takes off. But I've seen that happen with a lot of companies. One of the things that was interesting, I've got a company that has funded some startups, and what I've learned is that there's a couple of things that you look at when you invest. Is that you want to make sure that the product looks like it's pretty good, and secondly is you want to make sure the CEO has really got it together, that they can go take it somewhere. Because generally, even if you look at a product and it looks like it's good, if you don't have a CEO that can move on a dime and go with where the market needs it to, you can be in trouble. And you need to have somebody that really has got some, what I would say, chutzpah to take a look at what they're doing and make moves. So go ahead here, Lopo. Okay. Tell us what's been going on.
So I started Wahanda in 2008, and I've always been in the internet space and technology space. This is my 4th startup. And the history of it was I kind of, a little bit like Sammer, I kind of looked around and I couldn't understand why I couldn't book all my hair and beauty services online when you could book everything else online. And I wasn't really, I was a bit of an outsider to the industry, and the more I looked at the industry, the more I realized it was a really huge and interesting industry that needed to be brought online for many reasons. And so the very first page of my very first pitch, my first deck for investors said, open table for spas and salons. Pretty straightforward. Turned out that as we launched, and we were very lucky, we raised a couple $1 million right away, including one investor who is a big US billionaire who had invested in my previous businesses. And he came to London one day, he said, Lopo, what are you doing? I said, I'm working on a new idea. He said, great, I'm in. I was like, okay, I haven't told you the idea yet. He says, well, how much are you in for? He said, $1 million. I'm like, great. Then I kind of walked out of the dinner. I thought, I can only screw it up from here. So the idea was really to create this booking platform. And then what we found was actually it was going to be very hard to make that happen. And as we were trying to think about what to do with that market, the daily deal model showed up. And we were actually the first to launch a daily deal service in the UK. And it took off. Overnight, it just completely took over our business. And I kind of woke up 6 months later, 8 months later, and I found that 80% of my business was a daily deal business, and I never wanted to build a daily deal business. I thought it was an interesting thing to have side by side, but I didn't want to have a daily deal business. And that business grew, but at some point I realized that we kept building our booking system in the background. And at one point I realized that I just wasn't going to be able to scale this daily deal business, and the economics of the daily deal business weren't working. And I turned to my investors and I said, listen, I think we should stop investing in this, and we should focus on this booking platform. And this is 2012. And interestingly, I think Sammer and I was just exchanging notes earlier. I think you went through an interesting pivot around the same time. And so in February 2012, I decided to stop investing in daily deals. It was 80% of my business. By September 2012, I didn't have a daily deal business anymore. So I turned off 80% of my business. But in the meantime, I focused on this appointment booking, real-time booking platform, and that business just absolutely took off. And it took about 6 months for us to make back the position we had. But that was an incredibly tough 12 months. And so now we have a business which is really focused on that booking platform. And what's interesting is it looks remarkably like the very first page of my very first investor deck. And I kind of sit there going, would I have gotten to this place faster if I'd focused on my original vision? Or did I have to go through that journey in order to get here? Obviously, it's a question you'll never know, but it was, that was kind of the journey we've gone through.
And, back to what I was saying earlier is that you really, when at the end of the day, you bet on the CEO, and Annbeth's been shown that she really knows what she's doing when it comes to running a company. She's got a quality organization. So, Ann, how have you adapted your model over the?
Well, we the original business model was urban flagship standalone properties. And when I think we were 4 or 5 years into it, and the recession hit, and at that exact same time, we had built a brand, thankfully, and at that time, developers started recruiting us, for hospitality projects, residential, hotel, mixed-use projects, and they needed a brand that could help sell real estate, drive RevPAR, occupancy, and activate, infuse energy into their hotel residential projects. And we had both the boutique fitness and spa programming, so we were kind of able to do it all, and we had a brand. So all of a sudden, we were getting recruited to do these projects, and we were able to double, and by the way, at that time, we had no more capital to grow. So we doubled the unit size of the company. We opened 11 units during that period of time, all of them 100% funded by developers. So I don't know if I answered it perfectly, but I mean, we were able to fuel our growth in a way that I never thought would happen or saw coming. It just was an opportunity, and we took it and we went with it. But the key learning that came out of it was you have a business model, and you want every unit to look the same and feel the same and be the exact same 10,000 square feet with 10 treatment rooms and 2 studios and And that's how also private equity people think, is you've got a business model and it's going to be this many square feet. And we've come out of that with a very different learning and approach now, which is it's all about the brand and the programs. We can do what we do successfully in 2,000 square feet, 4,000 square feet, 8,000 square feet, and 25,000 square feet. If there's anybody in private equity out there that I insulted, I apologize, but it's really exciting to have a flexible footprint in bricks and mortar, because bricks and mortar comes with a lot of risk. So that was...
So Rick, can you add a little bit? Have you adapted your business model over time?
Quite a few times. In fact, it's really great to hear your beginning, because our initial vision, my first pitch was to a group of angel investors saying, if we wanted to book right now a plane ticket to Paris and book your hotel and your Eurail pass, we could do it from our computers. There weren't any mobile phones at that point doing it. But if you wanted to book a haircut or a massage, you'd have to pick up a phone, which didn't make any sense. So that's what a lot of us have been chasing for a long time. And so we reasoned it backwards, that we had to solve all the major business problems of these businesses so we'd have the real-time schedules. And we started that in 2001 with a desktop software. And the original premise was that we had a web scheduling tool that linked to the desktop software, and you could buy your 10-class series on the Upper East Side, and you could book your class down in Soho. It was a great marketing success, but it was a disaster of a platform, and so we had to completely pivot our platform in 2004 and reasoned our way into, why can't we just put all the functionality on the web, which a lot of experts were telling me, no, you can't do it that way. So I'd like to say I didn't know enough about it to know it wouldn't work. So that was the first pivot. The second thing I think that's really probably hit all of us is just the move to mobile in the last 3 years. When you think about it, in 2012, Facebook didn't have a decent mobile app. In fact, famously, Mark Zuckerberg said it was one of the biggest mistakes he ever made. Having to pivot our entire development team to be mobile-enabled was a massive move for us. And now over 70% of all of our software development is mobile.
So Sammer, you had the stage the other day, and not to be real repetitive on it, but maybe just kind of sharpen everybody's mind in terms of what maneuvers you've had to go through with Zeel.
Quite a few, and I'll echo some of the things that Lopo and Rick said. So when we first started, in fact, one of our first pitches, although in 2010, was open table for wellness and beauty. We all had that pitch, the open table for. And although I wasn't doing that out of personal experience, Lopo, I wasn't trying to book my own manicures. So yeah, we tried to build it. We worked super hard, obviously, but every salon, every studio we were dealing with had a different booking platform. Half of them were using Gmail Calendar. Nobody really wanted to pay, a $50 or $100 a month fee to have, a tool. We tried daily deals. We tried lead gen. We tried percent of transaction. I mean, nothing quite stuck. And like you heard yesterday, we noticed, after 50,000 plus appointment requests, that massage had this interesting on-demand component. So that was the first pivot into just focusing on massage, just focusing on New York City instead of nationwide, and just focusing on in-home. The second pivot, which came pretty quickly, was mobile. I mean, we saw mobile first as the real opportunity, and I'll give the credit there to Uber, because they were a mobile-only product, and they were just starting to take off. This was fall 2012, early 13. So that was the pivot. But Pete's right. It really is about the team. It's just hard for VCs sometimes to say, like, oh, I'm just going to bet on this team and give you guys millions of dollars that you could just piss away, because they want to see that the idea is good too. But the reality is we all pivot multiple times in these businesses. And some VCs are now telling me that this Zeel Professional tool that we're offering for spa is, quote, another pivot. Now, I beg to differ. I'm like, it's an extension, not a pivot. But they're calling it a pivot in some cases. So, it's a constant battle, I'm finding, to explain what you're doing and why you're shifting and what it means for the business.
So, Josh, you think you can add to that?
The one thing I'd say is, when we spun Spa Booker out of Spafinder, the biggest issue that we had was that we were perceived as just hotel spa software. And people, frankly, weren't very excited about investing in just hotel spa software. So we had to paint a much bigger picture about the market that we could go into. And kind of since then, over the last 3 years, we've really, expanded out of spas. We've added salons and other beauty businesses, but then we've added other service-based businesses to the platform as well. And now, kind of after our last round, part of our positioning was really creating a new category that we call service commerce. So everybody understands e-commerce that's buying, products online, but there's also 60% of the U.S. GDP, which is services, and the vast majority of those businesses are not online. So to Rick's point earlier about wanting to be able to book those type of services online, there's really not anybody that's doing that at scale right now. And so that's part of what our evolution has become is really, while we still support our hotel and spa clients, and that's still, the vast majority of our base, as we're expanding and looking through some other partnerships that we're working on, it's really going into more categories that are service-based, where people still have the same type of requirements that spas and salons do, such as, online booking, staff management, CRM, point of sale, but really taking the lens of what do service-based businesses need. It's not the same as a retail, it's not the same as restaurant, and really spending a lot of time kind of drilling down into the use cases that those businesses need help with.
So you try and make this panel where it connects with maybe some of your questions here, or the thoughts that are going on about, how do you end up raising capital? So let me ask this question that we hadn't put on here, but how did you identify where you were going to go for money in the early days? I'll go to Rick. We'll just kind of go down this line.
So for us, we bootstrapped it until we started developing the web software, and we realized that with a SaaS business model, we were very quickly going to go broke. because you know, if you're selling licensed software, you get several $1,000s up front, perhaps some maintenance fees. A web-based software as a service, you may have no money up front and be earning a small fee every month. It's worth a lot more in the long term. So we had to get very good at this, and it was really connections. My co-founder partner, Bob Murphy, and I were walking down Madison Avenue in New York and ran into an old prep school buddy of his, and that led to a meeting an hour later with this group of private equity people. That led to connections to an angel group called the Tech Coast Angels in Los Angeles. So I wish I could give you a great formula, except that you keep expanding your circles, your networks. You find the people that are passionate for what you're doing, and they'll probably connect you. Of course, the venture capital people, the angels will take applications right on their website. I don't know if I've ever heard of anybody actually raising money that way. But maybe somebody has. So yeah, and that led to us being able, that was our first $3 million back in 2005. And I didn't get to answer the question, by the way. We've raised over $200 million. So half of it publicly. Yeah.
So I'm actually going to double question this, because I'm going to ask you how you identified it here in a second, Logo. But I want to go back to, what did you prepare to get the money?
Well, the classic pitch deck. Right?
Was it all conversation you had with people? Did you do PowerPoints? I mean, how deep did you go in terms of...
That first meeting, I had no PowerPoint because we weren't even expecting it. So it was a stand and deliver moment. Could I explain it? And I really appreciate what Sam was saying. You know what one guy said to me? He says, you know what, I bet the jockey. So it is about the CEO. If you have a great idea and you don't have the energy to be the original salesperson for your business, you've got to go find that person. Because the CEO is the first and the last salesperson of the company. And you have to be able to just do it like that. It's the classic elevator pitch. But of course, I built a slide deck too and did all that. But I had to think about metaphors, the open table for the beauty industry. You have to give people a metaphor they can grab onto, because whatever your idea is, if it's truly innovative, they probably won't get it.
That's so key, by the way, Rick.
Yeah.
I always tell people, if you can't explain your own company in a sentence, you're screwed. And I couldn't explain the first Zeel to people. Well, it's a marketplace for health and wellness, and we have booking, but we also do daily deals, and we're doing some lead gen, and we're helping people find, and I was always screwing it up. And, you know, I knew that I was, like, you know, not on the right path, and it just took a long time to finally come up with the one sentence. But that is so key that we can impart one thing to you guys.
I agree that it's key, but I'm also going to say that 10 years ago, nobody used the word mind-body, nobody used the word transformation. Everybody thought I was a nut job. They said, you're confusing everybody the way that you're at, you know, this whole exhale mind-body spa business is very confusing. And I kept saying over and over, when Starbucks, I'm from Seattle, when Starbucks, you know, put up their shingle, nobody knew what the hell Starbucks was. And they breathed life and brand into Starbucks, and you can see what Starbucks is today. And so I really believed that creating our own language and our own elevator pitch or whatever, it was so important. And I didn't care that nobody understood what it was right up front. I knew that it would just have to come with repetition over time.
So now we're in a good space, maybe, huh? Today?
I mean, I think just pick up on what Rick said. Businesses are only about people, as far as I'm concerned. I think my number one job is finding, motivating, organizing people to build a great company. I think everything comes out from that: product, service, the marketing, everything, even the strategy and the pivots, right? You can't pivot, you can't do the right strategy unless you have the right people. So for me, it's the first and almost only thing that I focus on. And I think for VCs, especially when you're backing an idea, it's the only thing they've got is actually people. So I think you're absolutely right, Pete. You know, I have a friend of mine, a very good friend of mine, who actually was an angel investor in Wahanda, and he's one of the top angel investors in Europe. And he says that Excel spreadsheets, business plans, are a subgenre of science fiction. And he's proud of doing.
A figment of your imagination.
They are
right?
complete fiction. And he's proud of the fact that he's done over the past, I think he's done something like 300 investments over the past 5 years, and he's looked at an Excel spreadsheet once. He keeps track of it, right? And by the way, that investment didn't turn out to go very well. And it's all about people. And I think so. So one of the things I get asked a lot by young tech founders is they say, well, how do I raise money? And they all think that they want to kind of work on the pitch deck and get everything ready and then go out to the VCs or to any investor. And I always say, actually, wait a second. I mean, it's like dating, right? You're not going to get married on the first date, and which is what you're asking if you expect to kind of show up and knock on a VC's door and get funding. I mean, go talk to the guys. Go get to know them. People invest in people they know and people they trust, and the more that you have, the better. So it's a journey you got to go on at a very early stage. But it's hard in this industry. I think the industry is better understood, but I mean, in the tech space, VCs do not understand the space.
So, but one of the things that you brought up, you talked about your original business plan, and this is where you think that people start out to go raise money. They think, okay, one is talking to people in a living room, giving them an elevator pitch, but is there anything behind it that you need? In other words, you said, yes, they invest in you and the idea, but did you need to put paperwork together and numbers for any of the early parts of your investment?
Absolutely. I mean, you should not start a business without having done the numbers yourself, because even though it's science fiction, it's kind of, the purpose of it is actually is a way of figuring out how you're going to grow this business. What are the drivers of the business? What are the resources you need? Where will you invest? I have a board member who's fond of always telling me, he's a Japanese guy, and his English isn't very good, but when he says stuff, it's amazingly clear. And he says, strategy is budget. And it's just such a powerful thing. Where you spend your money is your strategy. And if you don't have a clear strategy, you're going to spend the money incorrectly. So I think you have to have the pitch deck, the Excel spreadsheets, everything else you've got is just it's an expression of what you're trying to build. And I think you have to have real clarity of that. And I think you have to have a lot of determination.
You also have to have a meaningful purpose. Some people call it a mission statement, a vision statement, a purpose. Our purpose is leveraging technology to improve the wellness of the world. And so when every decision we make about what we're going to develop next and how we might adjust course or pivot or extend has to answer the question, is this going to improve the wellness of the world? Is it going to help the business owners running wellness businesses be more successful? Does it help the practitioners do their jobs? And does it bring in more consumers into the marketplace? So having that really compelling vision, in fact, we just got to hear a presentation from the founder of Italy in New York, those Italian, and he called it a poetic vision. He's Italian, right? They make everything beautiful. What is your poetic vision? It's got to grab people. It has to excite them. And I think when you have that, then you've got them. Now they're interested. And so you've got to have some model that makes sense, but know that that business plan is going to cease to be relevant the day after you raise the capital. And they know that too.
Mm-hmm. And I think that's one of the things too, is that depending upon the stage that you're at as far as the capital that you're raising, a seed round of financing and the information you put in a deck and the detailed financials versus when you're going public, like the amount of insight and information and detail that investors or the public communities are going to want changes radically. When we made our first deck, I remember starting out and doing it, and I went to business school, and they taught you in business school to write these business plans that were this long, and I was like, no, I think I want to just do a deck, 10 slides. That's kind of where, where we started. And we started out also with a teaser, like a one-pager that basically said, hey, this is what this is about, this is what the, kind of financial model looks like going forward. And as we brought in subsequent rounds of financing, what we found was that the questions that the investors asked were a lot more particular. We had Bain Capital invest in our Series B, and so you can imagine a bunch of like PE guys and consultants getting into your financials. And on one side, it was frankly a pain in the ass because these guys were asking just questions that nobody in their right mind ever pays attention to or tracks. But within that were kernels of things that really helped us actually understand our business better. And for kind of tech companies like the ones that Rick and I run, there's some very specific metrics that every company in the space gets judged by: lifetime value, customer acquisition costs, and ratios of all of those type of things. And so when you're going out, Pete asked earlier about how to target. I think it's definitely network and tapping into people, and also most importantly though is finding people that are like-minded, that are investing in the type of companies that you might aspire to be. And also, Lopo mentioned about a date or whatever. It's a marriage when you get an investor. They're going to be with you for 3, 5, maybe 10 years. Rick's had some folks on his team for a long time. And so making sure that you have the right alignment with people, because not everything's going to go the way that you put down in your business plan. I think, more often than not, it doesn't go that way. So you want to make sure that you've got people on your team that can lock arms with you and run through walls.
Yeah, that's a great point.
Make sure you like these people. When you sit down in the meeting, how do they make you feel? It is like a marriage. In fact, it's probably easier to get out of a marriage than it is to get out of a venture capital investment relationship. So we always, Bob and I had the no, I'll tone it down, the no jerk rule. Life is too short to work with jerks. And there are plenty of really talented investors out there who are wonderful to work for. They're inspiring. They'll help you think through your business and take you to another level.
So, kind of a fun thing here. When you were, at any point when you were looking for capital, what kind of mistakes did you make? So, Lopo, did you make any mistakes looking for money?
Yes, you make mistakes. I mean,
Don't we come back to the question?
Maybe. I think I'm trying to think of ones where, in particular, that you messed up. But I think it's less about mistakes and more. I think more about this chemistry. This point, the point that Josh and Rick were just making about the fact that you really got to trust somebody. I can tell you stories about investor meetings where you walk out just holding your head, cringing, and I'm sure they probably felt the same way. And it's like they're just awful moments. And I think those are the ones that I think are probably the biggest mistakes. But if you're prepared, I don't know. So I don't have one where I can think of think God that, or at least nothing I'm willing to divulge here.
Let me add
Sammer,
one.
yeah, you go.
Let me add one that I think is relevant for all of us. We're in this space that's spa, wellness, retail, offline to online retail. I think a lot of VCs have trouble, wrapping their arms around this space. It's getting a little better, but I can't tell you how many VCs offices I walked into. They're like, massage? What? And most of these VCs are male. A lot of males don't get massage. 16% of the entire, adult population in the U.S. even gets massage, and most of those are women. It's like 80% women. So guys just don't understand this space as well, and the VCs aren't sure how it's going to go. And I think, there's a little bit of an uphill battle. So the mistake I probably made early on is just trying to get a rock star VC or a Silicon Valley VC. Josh has warned me about this multiple times, and I failed to heed his warnings. We probably shouldn't even go to Silicon Valley because this is just not the kind of company yet that they're going to invest into. And so I try very hard now to research the background of a VC. Does he get massage? Does he have a membership at Massage Envy? I found some of those VCs have been fascinating to talk to. They invested in like-minded things. Like Josh, you have Steve Case and Revolution. These guys get wellness. They're an amazing partner to have. So the big mistake is just to waste a lot of time with VCs who are just never going to understand your business because I don't think they're going to invest in it. And I've just wasted countless hours talking to VCs that I should have known better, not to. I won't name them, but you could guess who they are because they like to invest in Facebook and, Slack and, those kinds of companies, software only, super fast growing, 40% month over month, numbers none of us, I think, could really achieve. So.
Annbeth, you made any mistakes?
I think this is a more recent one, I've learned that you can waste a ton of time with people that are kicking tires and want to learn about your space. And it's important for them to learn about the space and understand what the metrics are. But you got to do your research before you spend an hour with somebody. And now, more than ever, I'm saying, you know, hey, talk to my guys.
Right.
Don't talk to me. I got to run a company.
I think that happens especially after you raise money. Everybody comes out of the woodwork that wants to be your new best friend, whether it's, you know, commercial real estate guys or accountants, and then every banker. Like, I'm sure that Rick had you know, a huge experience when he did his IPO interviewing, you know, a lot of different bankers. Right now we've got a ton that are calling us, and if I just wanted to spend time meeting with bankers and investors, I would shoot my entire day doing it. So similar to Annbeth, I'm very selective on the folks that we would meet with, because it's just 9 times out of 10 they come in and tell you all of these introductions they're going to do and all of these great things that they can bring to the table, and then you won't hear from them for a month, and most of the introductions either never come or they're with people that you're already dealing with, folks that are at a higher level than the ones they introduce you to.
Do not employ an investment banker to raise private money unless you're selling your company.
Yeah. Good point.
Agreed?
Yep.
Yep.
Agreed.
Yeah.
Completely.
It actually will make you look less attractive.
Yeah.
It's like you need a matchmaker to get a date.
Yeah. So find it on your own.
Definitely.
You gotta, yeah.
So I've got a question I was going to ask you personally,
Okay.
but I'm going to ask you publicly.
All right, I'm ready. All right.
How do you like being the CEO of a public company?
It's fun. It really is. I know.
It doesn't
so for
seem
those
fun.
we went public in June, and first of all, the behavior of the investors is very similar to everything that these guys know. It feels the same. In fact, the majority of our investors that are betting on us right now, who hold positions in our stock, they're talking about the institutional investors, either themselves are fanatics about fitness and wellness or are married to somebody who is. So this ability to connect to people matters. The wonderful thing is you can have a bad meeting with one of these people and it doesn't matter, because you walk out and there's 100 more like them. And I'm having a blast.
But what about, but Rick, what about the fact that every quarter you have to hit these numbers, and quarters go by so fast, you know, like, oh, we got to add 1,000 more retail, and
the first thing you got to be doing, of course, you do that with your own investors, right, is to be careful what you promise.
Yeah.
So you under-promise and over-deliver. That's the first rule, right? It's called beat and raise. The second thing is that what our investors want us to do is what we need to do, which is to keep growing, to improve our economics, to become a profitable company. So there's no cognitive dissonance between what the market is driving us to and what we are already aiming for. And if that weren't true, it would have been a huge mistake to go public, because the market can be really brutal. I mean, there's some companies that the SaaS companies went public before us, and I just look at their stock price and I go, oh my God, you know, they're worth like 1/4 public what they were private.
Which one? Which
Oh,
one?
wow.
Well, I know one, and she doesn't deserve it, so I want to give her credit. Kara.com.
That's true.
She's getting brutalized out there, and I don't get it. I mean,
Humbled,
it's a
yeah.
great company, and we had a rough ride when we first went out, and there's one good thing though. It really steals the team. So we got dissed. You know, our stock went down after we went public, and it's come back up, and it's doing fine now. The team felt like, wow, they don't get us. Like, they're underestimating what we can do, and so. My leadership team, our technology team, they've never been more focused and more just lit up, and we're going to prove to the world. And that's like gold for a CEO, right? So the opposite is our stock could have flown up high and we'd have a bunch of people drunk with money. And I think that would have been a real problem. I think there's some other IPOs recently that have that issue.
So
I
Sam,
won't name those ones.
let me go back. Sam, you make any mistakes raising money?
Besides talking to the wrong VCs all the time who don't get massage. Yeah, I mean, there are other mistakes, not only that I've made, but you know, I'm sure others have made too, like not raising enough money. I always try to raise more money than I think I need, because somehow you always spend more than you realize. The one mistake we've probably made at Zeel is that all of our VCs are terrific, they really are, and they all get massages and they love the product, so that's good, but not one of them has made a huge investment yet, so I'm sort of positioning the companies to get one deep-pocketed VC, you know, to come in, like Josh has done, right? Because when you do that, they can continue to support you round after round after round, and it's really important. So anyway, that's another one I got to fix over time.
So in a little bit, I'm going to ask questions. So Nancy, are you back there? Just going to say, do we have a mic that maybe we might be able to bring? I'm going to about 5 more minutes and then into some questions, but
Hey, Pete, can I
Yeah,
throw in one
sure.
thing on top of that in terms of mistakes? We didn't do it, but I know a lot of companies that have. And you really have to pay attention to the terms of the investment. And I know that sounds like a very obvious thing, but I think a lot of people get stars in their eyes about valuations and they go, I want to get this multiple or this level, but they don't look under the hood on what's coming in the term sheets. And especially in the software world, you read about it now with a lot of the unicorns that are out there that are getting billion-dollar valuations. But the only reason they're getting billion-dollar valuations is because they have all of these, participating preferred or guaranteed returns. And so really understanding the type of equity that you're selling, understanding what are there dividend rights, are there exit rights, are there lockouts that they have, that at the end of the day to me is one of the most important things that somebody in the early phases of raising capital has to pay attention to, because at the end of the day, if you don't pay attention to those terms, you could give away, you think you're selling 20% of your company, but you're selling 70%. Oh, yeah. And so...
But so one of the things, though, I think that the group may want to hear is that when investors or an investor is looking at and putting money in your company, what is it that they generally want? What do they want? When they say, okay, look, I'm going to go invest you, what do they want? So, Annbeth?
Well, you mean what are the critical things they're looking for?
I think every one of them looks at it and say, okay, I want to be able to take money out of it. What's my future going to be? That kind of thing. How are they looking at the investment? In other words, people don't put money in a company just to do good.
No.
They're looking for the financial aspect of it. So what do you think they look for?
Absolutely, they're looking for return, and it depends on what kind of an investor they are. They're looking for somebody that's got a brand. They're looking for a team that has, capacity and industry experience and proven experience in that field. They're looking for a concept that's differentiated and is in a market that's growing and has all the right market fundamentals. And I also think what I've learned, and again, I'm not the smartest person up here when it comes to, funding and capital structure, but I will tell you one of the things that I've learned, and I know it's true, is investors, there's this thing called group think. And if there's a lot of liquidation activity and a lot of transaction going on in a particular space, that's where you're going to see some really exciting, favorable valuations, right? People tend to flock to.
There's no question. I mean, investors, they like to say they're venture capitalists in tech space, but they're actually not that adventurous very often. So they like to follow. They definitely follow themselves, and the more people invest in a space, the more they'll do it. But I think in terms of what they're looking for, I think Josh's point about simplicity of, you'll see some investors look for a lot of protections. My rule has basically been, if you see a term sheet that's more than 2 pages long, just turn it back. My second rule has been, if you have an investor who doesn't have as much skin in the game, no investor's ever going to have as much skin in the game as you have, right? An investor has diversified risk, you don't. And that always puts you in a different position. But you want somebody who actually, for some reason, disproportionately believes in what you're trying to do and will be there when times are tough. And so I'll give you an example. Excel, who's one of the top venture capital firms in the world, wanted to invest in our first round. And I turned them down. And I got a call from the partner at Excel in London saying, "Are you crazy? I mean, you know who we are?" I'm like, "I know who you are. The problem is you're putting money in from your seed fund. And it's play money for you. And if you don't follow your money in the next round, no one's ever going to follow their money afterwards. So you don't care enough about this." And I purposefully chose a partner at another firm who I knew had never had an exit. I knew this mattered for him. He needed to have an exit. And sure enough, he stood by it. So you want to look for stuff like that. You want to look for simplicity in the term sheet. You want to look for somebody. You don't want to get these VCs who kind of come along and say, "I promise you I'm going to add value." It's crap. Most VCs, they're money. It's money first and foremost. What you want, the only thing you want is, will they be supportive? And I guess in terms of what they're looking for you, they ultimately want an exit. I mean, profitability. I mean, you've got 4 businesses here. I don't know. I don't know about yours, but most. I mean, our business is not profitable. The fact that you're profitable or not profitable, especially in tech space, is not as much of an issue. It's more about the growth, and can you show the unit economics? Can you show places where the model does make sense, where it does make money?
Where it scales.
Where it scales, and you can show how it scales, and you've created a formula for how it scales. That's what investors want, right? They want, and the more certainty you have in that, the more expensive you can put your price up. You know,
That's in the tech space, though.
Yeah,
Make
that's
sure
in the tech
everybody
space.
understands.
Very
That's
much
not
in
in
the
the
tech
bricks and mortar retail space.
Yeah.
Be very clear.
Well, you're right.
You're not gonna sell that
Investors look at
song.
stuff a little bit different. And, you know, when you start out a company, if you're, depending on the kind of the space that you're in, first off, for a lot of you, if you're starting out, you're going to be looking at friends and family for your rounds. And then when you get your friends and family done, you got to prove out that the business makes sense. And then next step. But maybe some questions now from the audience that you may have. Yeah, Nicholas? Here.
Hi, I'm Nicholas Ronco from Yellow Spots. I had a question actually
Well, watch out. Okay.
following up on what you just said, Pete, which is...
That's what you get when you have a CEO. A CEO just takes over. That's right.
So the question I had was following up on what you're saying, which is to the panel in terms of class of investors. So you start with looking yourself in the mirror, then friends and families, then angels, family offices, VCs, private equity. I'd love to get an idea from this panel as to what is adapted for what stage of development of this company. And again, this panel is quite tech-oriented and, you know, booking platform, so I'm glad you're here, Annbeth. So maybe you can enlighten me on that since we're in the same space.
Well, let whoever takes it, let's take it.
Take the Annbeth, take it.
No, so if I were doing this today and I were starting a company from scratch and I did not have a business that was cash flow positive and had proven my model, I would find influential, successful CEOs that were like-minded and understood me and knew what I could do, and I would raise money from friends and colleagues and strap it together, and then I would prove out my model. I would do a couple of units, prove it out, and then I would go and raise big money and then roll it out.
What's the difference between VC, PE kind of, you know, investment?
What was the question here?
Are you
He
looking
wants
for
to know what's the
scale?
difference between
are you looking
VC
for how big your business needs to be, or how much money they would put in, or what are you looking for?
In terms of the stage that you are in the development of your company, if you're cash flow positive or where you stand in terms of your growth, like you were saying earlier that your company, for example, is not profitable, but you were able to raise this, you know, a fairly large amount of money, and you spoke mostly to VC, but then you had a PE investment in your brick and mortar operation. So I'm wondering what's the difference and what's the different pattern between these two classes of investors?
So private equity firms typically only invest in businesses that are cash flow, and then they're going to acquire other companies, put them together, and make it more successful and more profitable. And so I did not have an experience with venture. Venture is typically
And I
for
think what
somebody that's
happened to you is
startup.
really important to the group here.
Yeah.
You know, really.
Well, so you guys can talk to venture and angel and
I think that, you know, on the venture side, it just starts out, you know, depending upon the size of your business and whether, you know, that's the type of business that, you know, most venture companies would invest in. And I think it is unfortunate, frankly, in more of the bricks and mortar space that there's not as much venture investment. I think that they usually look for people to build, and then there's certain, you know, PE firms that come in and say, okay, we'll buy in and scale. One of our customers is Dry Bar, and if you guys further in the States know all of the blowout bar craze that's happening, and this was a place that started literally doing mobile blow dries, and now they have, they've raised, I think, somewhere around $50 million, but they'd only opened 2 or 3 locations. They proved the model out. They had some good branding, and then a PE firm called Castanea Partners came in and wrote a $15 million check to fund their first real institutional fund. So I don't think you have to have a massive amount of runway, but I do think you have to have a kernel of an idea that's showing, and if you show some promise and a market expanding, that there are PE firms out there that you can raise from. But I personally don't know a lot of folks in the venture space that invest in more kind of bricks and mortar type businesses.
Yeah, and to give context to Nico's business, you have 3 yellow spas, I think. It's a new concept with healing and bright sleep and spa, and it's pretty interesting. And I think you've done enough now to go to some of those PE firms. I wouldn't know which ones, maybe Castanea. If they did Dry Bar, they might be interested in that concept, but I think it's PE for Nico.
It might be worth just taking a minute to explain why so many technology companies aren't profitable. It has to do with GAAP accounting. When Annbeth was opening her centers, the capital expenditure of opening those centers can be amortized across many years. Those of us that are running tech companies, almost all of the expense of building the software, building the sales and marketing team, marketing into a space to generate a recurring revenue stream that is very, very valuable. All the expense has to be borne in that period. And the present value of all the recurring revenue you're generating doesn't get to be recognized. So the people that invest in our kind of companies get that, and that speaks to what Josh was talking about. What is the lifetime value of your recurring revenue streams versus the cost of acquiring each unit? In our case, businesses running on our software. It's a different set of accounting. So it's just different business model than a retail business.
Let's grab it. Let's make sure we get some questions.
Mark called Body Holiday. I wonder if you could comment on structured finance and guaranteed returns, and to what extent that undermines the very objective of trying to raise equity, which is sharing the risk with you.
Sure. So a lot of these deals that we do are what's called preferred stock, and so preferred stock will typically get a number of really important privileges. The first one is a guaranteed return. In our case, it was 7% annualized. And secondly, that they would get first money out privileges. Thirdly are some really scary words that you want to write down and make sure you understand later, called participation and anti-dilution, really important things. They're looking, what are they looking for? They're looking to 3 to 5x their money in 3 to 5 years. And they're going to place 10 bets and know that 8 of them are going to fail. And so in that case, they're just wanting to get their money back with a cost of money component. So it does have a debt component to it. If you insisted on, no, I'm not giving you those things, you're simply going to take a lower valuation. And I think every entrepreneur or every founding team has to make that trade-off decision.
Does that matter at that stage, the lower valuation? Because you could say the Silicon Valley, this desire to be a unicorn is actually a bit of a chimera. Well, they go to float and they have a fraction of the valuation.
I mean, after I finally understood all of this structure, I came to understand why it makes sense. It makes sense because the entrepreneur believes in his or her vision. And I mean, you must have a high degree of confidence that you're going to succeed. The investor has a much lower degree of confidence. So what you're doing is arbitraging the difference. If you succeed, then these participation rights and all these other clauses become de minimis in their impact. And if you fail, they will not be de minimis. So I've come to understand that it's fair in the early stages. So I didn't get a chance to say the mistake we made was not getting rid of those things soon enough, because we did multiple rounds. And we did one too many round with that kind of structure in it. It cost us a lot of money later on.
So I personally, I never put any structure. Like we had a simple preference, and my rule was if I couldn't return the capital that people invested, then I shouldn't deserve to get to participate myself. So it was what's called a one times preferred, but there's no participation, there's nothing. And my rule was that if you allow participation in, then every subsequent round will have participation. Yeah. But we're getting to really detailed stuff. But one of the things I'd say as a general rule is that not everybody
not every business should or deserves to raise money.
Okay, we got one. I'm sorry, we got one more question. You were waiting in the back here, so let's do this and we'll finish it up.
My name is Olivier Bonfoy. I'm the owner of a company called Gentleman Sonic. And actually, this is very apropos. I'm in the middle of doing a fundraise for another company. It's in personal care, fast-moving consumer. I was just wondering, and actually you highlighted a number of the pointless meetings that I've experienced in the last couple of weeks. How much investor participation do you want post the fundraise? I mean, some of the meetings that I'm having at the moment, they want to be all over it. They have the time. I don't think they're the right people anyway. But I was just wondering, how much investor participation do you want post your fundraise?
I think it depends upon who you raise money from. Because if you raise money from people that are going to take over running your business and you want to be running your business, then you don't want to, that's not somebody to get married to. But it's also, I think, really important up front to define what type of engagement that you want and really looking for the investors that are going to bring to the table what you want. So like as a couple examples, in our case, our first round of financing was with Revolution and Steve Case, and that was somebody that understood the market. They had a lot of investments in health and wellness, and they had also invested in Living Social. And so understanding that kind of like local commerce, SMB in the United States was important for us. And then kind of fast forward to our last round of financing, we had First Data, who was a major strategic, come in. They're the largest merchant processor in the world, and so some of the things that we want to get out of them, they have actually no involvement in the day-to-day business whatsoever, but in terms of how we're building out sales channels and strategies, we're spending a ton of time with them on that. And so I think it's really, comes down to identifying what you want to get out of the investors. If it's just money, then you don't want to have them involved at all in running the business. Just take the money, and there's plenty of money out there to be able to do that.
I think it's one of the most important questions you have to answer.
All right, so we have to call it quits. I'm getting the word back there, and I'm sure that these gentlemen and this fine lady right here would love to answer any questions that you have tonight at cocktails, at dinner, or tomorrow. Thank you very much for attending.